Here's a look at the latest events happening in retirement planning. Brought to you by AnnuityQuoteAdvisor.com, where we help American workers and small business owners prepare and protect their retirement portfolios from stock market loss. We specialize in annuities, 401k and IRA rollovers, indexed universal life insurance, and small business owner 401k retirement plans. Please remember to click the like button and subscribe to catch all of our financial news and retirement planning updates. BlackRock, the world's biggest asset manager with more than $9 trillion in assets, is moving into annuities. The firm has a new target date retirement product for 401k plans that will provide workers a stream of payments through their lives. Called the LifePath Paycheck Solution, it embeds annuity contracts issued by Equitable and Bright House Financial, according to BlackRock. Once participants reach age 59 and a half, they will have the option to purchase a fixed individual retirement annuity to provide a guaranteed stream of income for life. Participants will be able to use 30% of their 401k balance in the product, according to a report in the Wall Street Journal. 5 employers have already signed up for the new product, including the Tennessee Valley Authority, which has about $7.5 billion in target date investments in its retirement plans. BlackRock expects that over 120,000 U.S.-based 401k plan participants will be able to access the annuity option starting in 2022, when initial plan adoptions are anticipated. As Americans are living longer and healthier lives, their risk of outliving their savings is accelerating the silent crisis of financial insecurity in retirement, said Mark McComb, Chief Client Officer at BlackRock, in a statement. By addressing spending and income in retirement, we're working alongside our clients and partners to help more people address these challenges. BlackRock's new series of target date funds will cost each employee participant about 0.1% for every $10,000 in the account. The fee will rise once the product starts to invest in group annuity contracts and has a maximum of 0.16%, according to the journal. These fees are less than the average 0.34% fee that investors pay yearly for target date funds and the 1% yearly fee they pay for fixed annuities, according to the Morningstar data cited by the paper, which added that BlackRock said there won't be commissions, sales load, or distribution fees for the annuities. How does an equity-based retirement plan compare to one that combines an annuity look like? Let's look at Clara and Owen.
Does the prospect of saving for retirement seem more daunting than ever? You may be concerned with market losses, the risk of outliving your money, and inflation. If you're trying to preserve your portfolio in an era of low rates and increased volatility, there's also the question of how you'll generate predictable, sustainable, and potentially increasing income, and that's only half of it. Compared to previous generations of retirees, your retirement strategy will need to rely more heavily on your personal assets to achieve your objectives. It all adds up to a lot of pressure on your portfolio. You may be thinking,
sure, there are risks, but how significant are they?
Consider this. Too much pressure on your portfolio can lead to depleting it and running out of money sooner than you expected. So much for living comfortably in retirement. The difference between a more secure future and a more uncertain one could be the success of your retirement income strategy. Our hypothetical friends, Owen and Clara, are here to show us why. They're the same age, they're each starting with $750,000 in savings, and both of them want to generate $40,000 in annual income in retirement in 5 years with no more than a 4% withdrawal rate.
While Owen is approaching retirement with his retirement account only, Clara plans to combine her retirement account with a fixed index annuity, or FIA. Let's start with Owen. To reach his goal, he needs to grow his $750,000 savings to $1 million in 5 years. During those 5 years, Owen will continue to grow his retirement account without making additional contributions and without making withdrawals. That will require his savings to produce an average annual return of 5.92% net fees. What are the benefits of Owen's strategy? For starters, he has control, liquidity, and flexibility of his assets, and the potential opportunity for more gains compared to other strategies. Except his assets are unprotected and exposed to risks, like market risk, sequence of returns risk, and the possibility of outliving his money. That means his income isn't guaranteed to last his lifetime either. And as another disadvantage, his account needs to return 5.92% net fees every year. So much for taking some pressure off his retirement portfolio. Let's check in to see how Clara is doing with her combined approach, a retirement account with an FIA.
In case you aren't familiar, an FIA is designed to meet long-term needs for retirement income. Some of the benefits include protection from market losses, tax deferral to help Clara grow her savings faster, the potential for credited interest based on positive changes in an external index, a death benefit to help her leave a legacy, and guaranteed income for life. Now, compared to an approach that uses her retirement account only, an FIA may offer Clara less control, liquidity, and flexibility of her assets for a period of time. This is because FIAs have a surrender charge and a market value adjustment if they are surrendered too early. Also, FIAs may have less growth potential than a sole retirement account has. Certain factors like caps, spreads, and participation rates will limit the amount of indexed interest credited. Clara's needs may change as time goes on, which is why it's important to understand the balance between all available features with any annuity. So, Clara purchases an FIA with $225,000 and continues to invest her remaining $525,000 in her retirement account, which is invested the same as Owen's retirement account and requires the same 4% withdrawal rate. After 5 years of waiting, her fixed index annuity would generate this much guaranteed lifetime income. As a result, she successfully reduces the pressure on her retirement account to generate the balance of income and only requires an average annual return of 2.34% net fees to achieve the same $40,000 in income as Owen. Keep in mind, this assumes no interest is credited to Clara's annuity during the 5-year period. In fact, any FIA interest she earns would take even more pressure off her portfolio, reducing her required average annual return of 2.34%. Clara's combined approach is more efficient than Owen's only retirement account because it requires a lower rate of return to generate the same amount of income and reduces the overall risk of outliving her money as well as withdrawal pressure. Her approach also adds more flexibility and potential for income and growth because a portion of Clara's expenses are covered with guaranteed lifetime income. These factors will help take some pressure off her retirement portfolio in exchange for a level of certainty toward the lifestyle she hopes to sustain.
No one, not even Owen or Clara, can predict how long they'll live or how the market will affect their retirement. That's why it may be important to manage and protect a portion of your portfolio from longevity and market risk with a fixed index annuity to help you maintain the retirement lifestyle you want for as long as you live. Ask your financial professional how a fixed index annuity could help take some pressure off of your retirement portfolio.
So, when do annuities make sense? Annuities make sense for a person wanting to save and grow money for retirement safely. They offer tax advantages, the ability to earn an income for an entire lifetime, they can help pay for long-term care expenses, and you can leave an inheritance for your heirs and avoid probate in estate planning. In addition, they help those needing public assistance to maintain some assets while participating in the state's Medicaid program, and annuities will protect assets from stock market volatility. If you are concerned about rising taxes and inflation, if you are in the red zone and you are 5 to 10 years away from retirement, if you are concerned about stock market downturns, and if you are concerned about rising healthcare costs in retirement, then an annuity may be the key to a secure and comfortable retirement. It helps to have a plan to achieve a more secure future. Get your free annuity quote today. Tax-deferred solutions such as fixed index annuities are safe from stock market loss and provide you with protected growth. Lifetime income. A death benefit for your family and liquidity. At annuityquoteadvisor.com. We work with over 25 of the top A and A+ rated carriers to find you the best rate. Let us put our expertise to work and find you the best annuity for your age, time horizon, and goals. Get started today. Learn more at annuityquoteadvisor.com.